on the Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the show, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets will be covered here. If you got credit issues and you're looking to buy a home and you're being held back because your credit scores are too low, you've got an enormous amount of collections and just trying to figure out what to do. Don't bury your head in the sand. There is help for you. We've helped numerous people be able to recover from bad credit, and it's just as simple as taking the first steps, which is just reaching out and calling us, letting us know what your problems are, and having the credit experts solve your problems. And sometimes it can be done as few as days as 30 days to 60 to 90. In whatever case, get it squared away now. If you're looking to refinance the lowest rates in U.S. history, obviously, this past week we've had a huge spike back in interest rates, and many people had missed the boats on refinancing. We're going to jump into that later in the show and discuss why you should consider refinancing today. But if you have any questions regarding anything that we cover today, please call in the off-air phone number, which is 877-245-2030. That's 877-245-2030. Or you can visit us via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. We've got a great show lined up for you guys today. There's a lot that's been going on in the markets the last few weeks, and wanted to catch you up to speed. Joining me on our panel to discuss the many issues is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you doing?
I'm doing well, sir. Thank you very much.
Excellent.
We've got a ton of stuff to jump in today. The first thing that I obviously wanted to touch in, which is one of the most important things that's happened, last Thursday and Friday, the mortgage bond market completely tanked. Interest rates are actually skyrocketing, and when I say skyrocketing, I don't mean like they're going from 3 to 6%, but they've jumped up, significantly over the last to a 4-month high. I mean, we've been seeing rates trade in a pretty tight range for the last year and a half, and now all of a sudden we get a pretty huge spike. And it's interesting because I was flooded with emails and voicemails over this past weekend asking me what's going on. You said interest rates could go up and it could go up quickly. What happened? Well, we've got a lot that's transpired over the last couple of weeks. It started, as we had mentioned a couple of weeks back, Louis, where the Fed had basically came out with a statement saying that they may not extend this quantitative easing into past 2013. They're going to start slowing it down, acting as if the economy is starting to turn around and trying to really pump up consumer sentiment and act like everything's okay. We had the jobless claims number come in better than expected, but as you and I have discussed numerous times, that number is really meaningless to me.
To you and I, it's meaningless, but not to the market.
But not to the market. They really use that as a gauge as to where they feel like the overall economy is.
And they also know that's the number that the Fed is using, whether it's the right number or not. So if unemployment reaches a certain level, I think it's 6.5, all bets are off, they say, for doing quantitative easing.
Yeah, absolutely. So, I mean, at this point, we're headed in that direction as far as what the Fed is pushing out there in the market, that the Bureau of Labor Statistics, the information that's being given out there. I mean, that everybody's hanging their hat on that. And, what's interesting is that the stock market continues to be pushed higher. I would actually have thought that at a certain point when they realize that, we're not going to have this accelerated stimulus in the mortgage market, it's going to slow down, that the stock market would start to think that this is going to be negative, because their premise is that most people feel like, housing is a very important factor to the housing recovery. Well, if interest rates start to slide up relatively quickly, what's going to happen to the housing market again? It's going to start to tank. The majority of people that are buying right now are making a decision to buy based upon a low interest rate environment, low down payment, and as we're going to discuss later in the show, the government is still trying to rule on the actual qualified residential mortgage and what constitutes a qualified residential mortgage, which could actually affect down payments and how much money people have to put down on a property, as much as 20% in order to get into a home. So there's a lot of things that are going on behind the scenes right now that could play a critical role in where we go.
Oh, well, another one, Ryan, that was very important was the announcement last week by the German Bundesbank that they're going to repatriate their gold. And an interesting point in that was somehow it's going to take 7 years to return 1/5 of the gold that they have held by the Federal Reserve. And the reason this is very important, to me at least, is Bernanke has said, and the central banks kind of scoff at the idea that gold is money. And Ron Paul had once asked Bernanke in a congressional meeting, then why do you have it if it's not money? And he said it's an asset. Now, if you remember back in the late 60s, what kicked off really the inflation of the 1970s was France continually asking under the Bretton Woods Agreement, which allowed for at least governments to convert their dollars into gold. France was coming over every once in a while and picking up large boatloads of gold from the U.S. Treasury. And finally, in 1971, Nixon said, we're not going to do that anymore, and we're just going to say the dollar is not backed by gold under the Bretton Woods Agreement. It's backed by what we say it's backed by, and we've had that in place ever since. Now, if this sets off another round of doubt about the value of the dollar, because I guess people got used to currencies being fiat, but now if countries are starting to back their own currencies by gold, as we know China is doing, we know that Venezuela asked for their gold back, so did Libya, and now Germany, then the concept of a currency just being backed by the good faith and credit of the sovereignty comes into question, and that could kick off inflation. And again, that will have a severe impact on interest rates because if the value of the dollar is called into question, or the integrity of it, that's when the sovereign has to pay more money. And that's exactly what happened in Greece when they realized, well, wait a minute, they might not be part of the euro and the euro might not back them. Then your borrowing costs, the sovereign's borrowing costs, go sky high because investors demand a higher interest rate. And if the answer is the Fed is just going to buy the U.S. Outstanding debt obligations, that'll even further undermine confidence in the dollar.
Yeah, and I mean, it seems like what you just laid out there is pretty much where we're headed. Not to mention that last week, a majority of banks over in the Eurozone had agreed to start paying back a lot of the funds that were lent out to them under the long-term refinancing operation that they set out there. Not only were they paying them back, they're paying them back sooner than expected, which gave the markets basically evidence that there's the panic that was out there on the EU is not as justified as it was 6 months ago. So that's going to further start to develop where, okay, well, maybe the Eurozone's not as bad, so, we need to probably maybe start pulling money out of bonds here, which is what people are doing. Rates are going up. I would think that people are going to start to have, their confidence is going to wane more and more about the United States, as you laid out, because other countries are backing their currency by gold. We're going to start to see mortgage interest rates head back up, which I think is going to have an overall negative effect on the housing market here. And we have the Fed coming out with language that is making it seem like everything is just peachy.
Well, the other thing which is interesting, besides that Germany wants the gold back, is that why does it take 7 years to get 1/5 of their gold back? I mean, with today's, even back in the 60s, you can send over a warship and collect it. You now have aircraft carriers that can take it. I mean, a lot of people are speculating that the gold that is held by the Fed has been almost been put into kind of a fractional reserve banking style where that gold has many claims on it, has been lent out, hypothecated, and so forth, and that while it exists in its physical form, it has claims on it, and they have to do some readjustment of how they're managing their gold reserves to make sure that Germany gets their gold free and clear.
Yeah. I mean, I totally...
That's quite concerning.
Yeah, it is. It's very concerning.
It shouldn't take 7 years to collect 1/5 of Germany's gold.
No, not at all. And there was actually another report out of Germany that showed that their economy had showed its largest month-over-month growth margin since 2010. So it seems as though, most of that Eurozone is starting to head in a positive direction. I guess, according to the Bureau of Labor Statistics, we're heading in a positive direction. I just don't see it. I actually believe that, and we've been discussing this for a while, like people that are on the fence about potentially refinancing their homes or purchasing a home. I mean, we've almost, over the last couple of weeks, had a 0.5% increase in interest rates. Okay.
Well, that's a 0.5%, but that's not a percentage increase. I mean, it's that's
I'm talking real numbers. Yeah,
that's a point, right? That's a 0.5 point.
A 0.5 point. Yeah,
but
exactly.
But a 0.5 point on 3 is what?
Well, you're talking about
it's like 15%.
Instead of, just to give a real life example, let's say that somebody was going to take out a FHA mortgage. Let's say that they were going to pay one origination point to get 2.75%. Now that same mortgage to pay 1 point, their interest rate might be 3.25%. So a whole 0.5 point higher, which then reduces your purchasing power. Right, reduces your purchasing power, and ultimately, see if that's a continuing trend. I feel like that's going to put downward pressure on the prices of homes, and I would start to believe that prices are going to start to come down. Now, that's not going to hold true everywhere because, as I've stated numerous times, in the Washington D.C. metro area, Northern Virginia, D.C., Maryland, we have an anomaly in many neighborhoods and subdivisions just because there's so much of an undersupply of homes that naturally prices have just continued to rise. And I feel like even if interest rates were to get to the 4% level, I feel like they'll still rise because there's just not enough homes. But that's not going to hold true across the country. I would say as far as the national landscape looks, that this would cause downward pressure on overall home prices.
But that shouldn't really be the only reason you purchase a home, because even if you get one of these low interest rate loans now, and the value of your home as a result of rising interest rates in the coming years drops a bit, your cost of ownership is lower because your monthly payments are going to be lower.
I agree with you wholeheartedly on that, Louis.
And that's really the way to look at it.
That is the way you're supposed to look at it, right? But what many people do is they get so caught up in this interest rate hype that they start to just say, well, you know what, I'm going to wait for the rates to come back down again before I purchase, right? It's always this theme that they have to get the best deal possible. What many people fail to realize is that it's impossible to time the market just perfect. And you hit it kind of on the head, because whether it's a 3% interest rate, a 4% interest rate, a 5% interest rate, those are all fantastic interest rates to be able to secure long-term debt, your largest debt that you'll probably ever take out in your lifetime, for 30 years.
And your mortgage payment isn't going to change. And if rates are going up, that's an indication that you have inflation, which means you've locked in your cost of living while all other costs are rising.
Yeah, and
even if the value of your home drops a bit, you should be able to absorb it based on the savings you're paying by not paying higher rent or a higher mortgage rate that you purchased 3 or 4 years from now.
100% agree. I mean, it's just, right now it's a perfect option. While interest rates are still, close to all-time lows, they've obviously had a significant jump up in the last couple of days. But what I'm really trying to tell people is that, it's whether you're paying 3 or 3.5% or 4%, it's still a great deal. And you should be actually purchasing a home to protect yourself from future inflation. It is an asset long term. Just don't be looking to buy the home to potentially, sell it 6 months to a year from now and make money.
Unless you're an investor and you've calculated these things and you have access to credit and you do this for a living.
Absolutely, and there's always a caveat to these things, because there's numerous investors that are out there that are doing that right now. And I myself do this. Okay, so I understand that there's applications for certain people, but if it's just your everyday guy or gal that's out there,
primary residence.
Right, just looking for their primary residence, a first-time home buyer, don't buy the home with the intentions that you're going to get rich off of it. Realize that, as far as your long-term financial plan, this is an integral part of it, because you're able to fix in this long-term debt at
a very your finances and handling the largest expense that you have.
We're up on a break, Lewis. When we come back, we're going to dive more into what's on deck this week that can affect interest rates and how you can lock your interest rate in today. When we come back, stay right there.